Hello and welcome back to TJ Economics, where today we're going to be looking at a Year 12 microeconomics topic. We're going to be looking at financial markets and how you can have market failure in financial markets. So, a financial market can serve various roles in our economy. Sometimes they can go wrong though, resulting in market failure. Today we're going to look at the roles they play and then how they can go wrong. So the first key role that they serve is to facilitate saving. They can lend to firms and individuals. They can provide the ability to trade goods and services. They can reduce risk with futures markets, and they can allow stocks and shares to be traded. So let's have a look at each of these individually. So facilitating saving then. What does this actually mean? So whenever you go to the high street and you get an account here, we've got HSBC or NatWest or Virgin Money or even Barclays. Anytime you have a savings account, you want to store your money for future use. Consumers can do that, firms can do that. That is one role that financial markets can achieve. And so we can sort of summarize that by saying financial markets allow firms and consumers to store any excess profit or income they receive in order to use this value at a later date. This allows, crucially, for more consumption and better investment, etc., in the long run. So one of the key roles in allowing saving is that it means we can do better investment and more consumption in the long run. Our second key role then, lending to firms and individuals. Again, think of consumers borrowing to buy a car, maybe using their credit card or a mortgage to buy a house. Firms investing in new capital, so in this case a digger, or maybe more machinery, or maybe even buildings and planes and whatnot. So, why is this a key role? Because financial markets allow firms and consumers to borrow funds for investment or consumption. This means that consumers and firms may be able to purchase or invest more than they would otherwise be able to. Think about it. A lot of consumers would not be able to buy a house in one go or a car in a lump sum. And so by being able to borrow that money, it allows them to consume now rather than having to save up. Same for a business. Maybe there's a machine they would like to buy. They couldn't afford to do it in a lump sum. So by borrowing the money, it allows them to invest now rather than having to wait. And so I'm sure you can imagine the benefits by allowing firms and consumers to purchase and invest more than they otherwise would be able to. So our next financial market key role, the ability to trade goods and services. So again, anytime you tap your card, anytime you transfer money from a bank account to another, even when you import or export goods and services, that is trading goods and services. And financial markets mean that you can do that much more easily. Firms can transfer funds much more easily. Consumers can pay for stuff much more easily. And again, that means we can invest and consume much more easily. And therefore, we're going to invest and consume much more. So, our fourth key role then, reducing risk with futures markets. If you're a firm that buys or sells a commodity like oil or corn or soybeans or anything like that, any commodity, it can be quite tough if you have a volatile price. You do not know what the price of oil is going to be in a year. No one does. You can guess, but you can't really know it. And so futures markets, a futures contract, basically allows you to set the price of that commodity a year in advance, a couple of years in advance, however long you want in advance. And financial markets allow us to do that. And so if you're a firm that uses oil, you could write a futures contract and trade that in order to guarantee a price of oil in a year's time. Likewise, if you sell oil, you could do the same to guarantee a price in a year. That reduces your risk because you know exactly how much the price of oil is going to be for you in a year, and therefore you can plan accordingly. That's important, it's a key role, because it means that we can buy and sell commodities and set a price for them at a future date, allowing for greater certainty for firms, inspiring business confidence, and therefore inspiring more investment. Our last key role then, trading of stocks and shares. So again, think of the stock market, think of buy, 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 sell, sell, sell. Basically, stocks and shares and the ability to trade them. It means that firms can much more easily raise funds through the sale of stocks and shares. We wouldn't be able to do that without financial markets, or indeed, it would be a lot harder. And so by using financial markets, it means that we can raise funds much more easily, allowing these firms to use these funds in order to invest more capital, take over other firms, expand their operations. It allows them to raise the funds needed to do that. So we have our 5 key roles then, and they are all key because they are key to a healthy and well-functioning economy. By them all working as they do, we allow firms and consumers to access various different markets, encouraging them to consume more and invest more. As a result, we have significant micro and macro benefits to the economy. So, whilst financial markets do serve a few key roles, they can go wrong. When financial markets fail to self-regulate, or indeed they are poorly regulated, they will fail. Thus, there can be market failure in financial markets. And again, similarly, there are a few different ways in which they can go wrong. Let's have a quick refresh though. Market failure, any situation where the free market fails to allocate resources efficiently, meaning that it is not allocatively efficient, resulting in market inefficiency and deadweight loss. Therefore, we often find that resources are over or under allocated to markets when they fail. We've looked previously at public goods, externalities, asymmetric information, and a few other ways in which we've had misallocation of resources. This can also occur in financial markets though, and let's have a look how. So we've got a few different ways. The first, asymmetric information. Regulators may not have sufficient or good quality information, meaning that financiers may know more about their dealings than regulators. Externalities. The decisions taken by firms can have huge external costs. The '08 financial crisis caused huge government bailouts, mass unemployment, and in some countries, we're still feeling the effect today. Moral hazard, the too big to fail problem. If a bank knows that the government will bail them out, there's an incentive to take riskier decisions that they otherwise may not normally do. Speculation and market bubbles. Market bubbles can lead to investors responding to incorrect incentives. In trying to ride the wave of a bubble, they may invest in something they shouldn't, thus causing market failure. And lastly, market rigging. It's been found that some interbank lending rates, such as LIBOR, etc., have been rigged in order to favour some firms. This happens because the rates are based upon self-reported data and information. So, let's have a look at asymmetric information then. So, think of the rules and the laws and the regulations that govern our financial systems. In the UK, for example, they are regulated by the FCA and the Prudential Regulation Authority, and it's their job to make sure that they work as intended. However, financial markets are incredibly complicated. There are all kinds of transactions, products, and dealings that occur, and it's incredibly likely that not all parties will know exactly what's going on. Therefore, financial firms may over-allocate resources to some investments that are quite bad, or they may under-allocate resources to others that they should. Indeed, it means that regulators can't do their job properly, and we may get a misallocation of resources. Our next one then, externalities. Again, we've said that there are huge external costs when things go wrong. Think of the Lehman Brothers closing down in the '08 crisis. Think of Northern Rock having to close down in the UK. The thing about this is, financial firms, such as the pension firms that almost went bust in the 2022 mini budget, look what happened. The Bank of England had to step up and buy almost £60 billion worth of bonds just to save the pension market from going down, from going under. And so that's an externality, surely. Because what happened, and what we mean, is that the financial firms, as we've said, have impacts that go far beyond their own markets. When things go wrong, they can cause huge problems for large sections of society. Obviously, they can go well and help us. But in the UK, for example, in '08, in 2020, in 2022, a lot of people's wealth was nearly wiped out because of poor decisions made by financial firms. And so we could get negative externalities in the financial market. Let's look then at moral hazard, the too big to fail problem. So you may remember that back in 2008, Alistair Darling and Gordon Brown here, the Chancellor and the Prime Minister at the time, bailed out Lloyds and the Royal Bank of Scotland to the tune of quite a lot of money. And of course, that in itself can provide a problem, because if governments set a precedent where they will bail out or rescue large firms, they may then act irresponsibly. Because if they don't bear the consequences of their own actions, they're incentivized to make riskier decisions. After all, why not take that risk? I'm not going to have to pay if it goes wrong. So in the run-up to '08, many firms and banks knew they might be bailed out. Speculation and market bubbles then. A classic example of a market bubble was in 1637, tulip mania it's called. Here we have an index showing the price of a tulip bulb, one single tulip bulb in the Netherlands in the year 1636 and 37. You can see in the space of a few months the price rocketed and then the bubble burst. Why is that a problem? Well, if we look at more recent trends, here we've got the Nasdaq.com bubble that occurred in 1999. We've also got the Bitcoin bubble that peaked in 2017. What's the problem with this? Well, let's look. Rapid rises in prices of commodities may cause firms to make irrational decisions with their investments. Seemingly endless rises entice some firms to invest money and resources there, consequently failing when demand for the commodity slows and the bubble inevitably bursts. Of course, if you have over-allocated resources to a commodity that then bursts, that's going to be a problem, and that could cause market failure. And then lastly, market rigging. So, The London Interbank Offered Rate is a rate that is recorded in financial markets. And what it is that banks will report how much they are paying to borrow money. And so it's called the interbank offered rate because it's how much they are paying to borrow off each other. And if you have a lower rate, it suggests that you're more financially secure than you are. And so what a lot of banks were doing was underreporting their LIBOR rate. And thus, the market was rigged because banks were lying about how much they were having to pay. Therefore, the information was wrong, it was false because it was self reported, and so the market was rigged. Other firms who relied on that information had problems. And so, market rigging was a problem because firms could give the false impression of being safer by lying how much it cost them to borrow. Millions, billions, trillions of pounds of investments every year rely on LIBOR. Therefore, other markets may be, incorrect, may fail because of that false investment. And so market rigging, where markets and rates and all kinds of things are rigged to favour some firms, could cause market failure. So we've got our 5 forms of market failure in financial markets. A summary then. Financial markets serve a few key roles, such as the below, and these allow the financial system to work in order to provide confidence and funds for consumers and firms. So in the long run, financial markets are key because they inspire consumer confidence and business confidence, and therefore we have better consumption and investment in the long run, and markets are more easily able to facilitate the good allocation of resources. However, financial markets can fail, resulting in misallocated resources and market failure, and indeed deadweight loss. Because of those 5 factors we looked at, sometimes allocated resources don't work in financial markets. Asymmetric information, externalities, moral hazard, bubble speculation and market rigging. These are just 5 ways in which financial markets may not work properly, and therefore we may misallocate resources. If you've enjoyed today's video, please do like and subscribe. Feel free to leave a comment on what I should do next. Follow me on Twitter, follow me on Instagram, and I will see you all for the next video. Bye bye.